afternoon, ladies and gentlemen. Thank you for joining us today for our webinar titled, Are You Prepared for What 2017 May Bring? My name is Dan DiVizio. I am a Client Relationship Manager here at Krasny Financial, and I will be your moderator today. Today's webinar will be presented by Steve Tuttle, our Chief Investment Officer and one of the firm's partners. For today's agenda, we're going to start by reviewing what happened in 2016 and what lessons were learned. We are then going to discuss the current climate and our take on it. And finally, we will be discussing our outlook and potential investment opportunities. Again, thank you for joining us today. I will now turn the call over to Steve Tuttle.
Thank you, Dan, and thank you all who have been able to join us here today on the webinar. As Dan mentioned, we're going to start with a quick review of what took place last year, 2016 review. It was certainly an interesting year. I think in the end, markets generally treated investors pretty well. But if you recall, we started in negative territory right off the bat in 2016. It was, in fact, the worst start to the year on record for the stock markets. A lot of it had to do with fears of an imminent recession. But markets quickly rebounded as economic data improved and turned positively just a month or so after that sharp decline. The rest of the year also resembled somewhat that of a roller coaster, as we had some concerns growing about the Brexit vote in the UK, as the UK voted to leave the EU. That created a very sharp and violent sell-off in markets, but again, markets surprised and rallied soon afterwards and calmed down. Then as we approached the US elections, and all that went along with that, there was, again, an increase in volatility, a brief sell-off in markets, and then we had a nice rally into year-end. So I just want to reiterate a few things about last year, and the main thing that jumped out at me is how the experts got a lot wrong, right? So they were wrong about recession, they were wrong about interest rates, they were wrong about the Brexit vote, and in general they were wrong about the U.S. elections. So it just reiterates how difficult it is to make predictions, and it's certainly not a prudent investment strategy to follow these pundits and base your strategy on short-term predictions. In terms of asset classes and sectors, it was definitely a risk-off environment for the first part of the year. This slide here shows how in the first half of 2016 it was the defensive or safety sectors that performed best. So long-term treasuries and gold had very solid first half to the year. And then there was a dramatic change in sentiment and a rotation out of those sectors. So gold was actually the worst performer the second half of the year, and long-term treasuries also performed very poorly in the second half of the year. But what led into the end of the year were small-cap stocks, value stocks, more risky investments rewarded investors. So can we draw some lessons or some conclusions from 2016? And I think it's always helpful to take a step back, review what took place, and see if there's any lessons that we can learn. And there's a few takeaways that I came up with that I'm going to share with you all now. One, it's very important to remember, and this is very consistent through history, so much of the return from investing comes in very short and unpredictable bursts. And this reminds me of the saying that what's important is that your time in the market, so being invested, and not necessarily market timing. It's important to be there when those quick and sometimes unpredictable bursts take place. And 2016 was no different, as we saw. Most of the returns were generated in a very short period of time. The other lesson I think that's important to remind everyone is that fundamentals work over time, but not all the time. So last year, beginning of the year, taking risk was not rewarded. for investors in general. But as the year finished out, owning good companies trading at reasonable prices with attractive growth prospects did reward investors. And we think that environment is set to continue, and we do think fundamentals will work, but again, it's over the long term. They don't work every short period of time. I highlighted this from the last slide, but obviously predicting the future is extremely difficult. More importantly, and maybe more challenging than even just predicting what's going to happen, it's predicting how events will impact the markets. Markets are the collective opinion of millions of investors and billions of dollars of assets, and it's very difficult to predict exactly how they will react to events. There's always uncertainty in investing, and the strong takeaway for me is don't wait until all is clear. Don't sit on the sidelines until you're perfectly comfortable investing. Return is generated specifically because there's some risk involved, and that usually coincides with uncertainty. So it's okay to be invested in the stock market or in a nice balanced allocation, even if there's some uncertainty or there's some risk in there involved. That's exactly how we expect to generate returns in the future. And then finally, discipline. That's a very key part of our investment strategy, and it's something that I think was rewarded last year if you were able to stay disciplined, to have a good plan, and to stick to it, even in the midst of short-term volatility. And I remind everyone that volatility in itself is not the enemy. Volatility is the typical ups and downs that takes place in the market, and unfortunately, that's the cost of generating return. That's the cost of trying to produce returns and achieve your goals in the long term. Now, we all know we have a new administration in place here in the U.S., and it is generating a lot of chatter, some concern, some excitement, or whatever camp you reside in. There's a lot of attention being given to our new president. But I want to remind everyone, and we've said this before, we don't think it's prudent to mix politics and investing. And part of that has to do with the fact that we strongly believe that the president actually has less power over the economy than you might think. And we haven't found any evidence that shows that who the particular president is and what party he's a member of will drive the economy. In fact, it might be just the opposite. What we've shown and what we've seen is that the presidential reputations tend to move in large part based on how the economy does. And in fact, perhaps it's just the stage of the business cycle that we're in when a particular president comes into power that influences whether we think a president did a good job or did a poor job. Think of Ronald Reagan. Think of President Clinton. They both came in at times when the business cycle was ready to explode, and the economy did very well, and therefore it's generally understood that they did a good job as our president. On the other side, think of President Carter or President Bush. They were in different points of the business cycle, and history probably looks at them not quite as positively, a lot in part because of where we were in the economy. So I'll just remind everyone, it's certainly good for the media. It's certainly entertaining for some to follow all the events of the new administration, but the White House actually does not have as much control as you think. For example, the president doesn't set monetary policy, doesn't raise rates or lower interest rates. That's the Fed's job. The Congress actually sets our fiscal policy, our taxes and our spending, not the White House. Sure, the White House has opinions on that, but it's actually Congress that is tasked with that role. So just remember that when you're watching TV or reading an article about how this president is going to impact the economy. So what do we look at if it's not who the government is and what party is in power? Well, there's certainly some very specific factors and indicators that we follow that we do think have an impact on our portfolios and on our investment strategy. And I'll highlight a few of them here. First of all, the economy. Right now, we're in what we would classify as a slow but stable growth environment for the U.S. Recently, we've seen some inflationary pressure start to rise and interest rates start to rise. Some of this has to do with the fact that our labor market is generally improving and wages are finally starting to rise. So this is definitely, in our opinion, a pro-growth scenario for investors. As far as the Fed goes, they are raising rates. They do intend to continue raising rates, but we think the pace will be very moderate and shouldn't have too much of a negative impact on the economy. I think it's more a matter of the Fed is normalizing rates and not necessarily trying to slow down the economy. In terms of sectors that we favor currently, given this climate, clearly cyclical sectors have done very well since the summer, since the Brexit vote and the U.S. elections. And we do have some proprietary macro forecast tools that to us indicate industrials, financials, energy, and materials should continue to do well in this environment. In terms of sentiment, there's definitely, we've seen a shift more towards a risk-on environment since the U.S. elections, but yet we're not at that point where I would consider the sentiment excessive. I don't think we're at a point where I would be overly concerned that market participants are too positive, too bullish on the stock market. And of course, earnings, this is related to what's taking place in the economy, but certainly earnings are a very important component towards stock investing. And I highlight this chart because it does show that we did have a period of time last year and prior when the S&P earnings were actually slowing. A lot of this had to do with the energy sector and the decrease in oil prices. But as you can see, it certainly seems like our earnings are increasing now finally. They've turned around and the expectations are for that growth to continue accelerating. So what that means to us in terms of our equity exposure, our stock portfolios, we do want to favor those cyclical sectors, industrials, materials, energy, and financials. During our last rebalance, those were areas that we emphasized, and it's something that we may continue. From a style point of view, we do favor value stocks over growth stocks currently. We own both in portfolios, but we have a little tilt towards value. In terms of size, smaller caps and mid caps seem to be better positioned than large caps currently, so we're going to continue with that bias. And finally, in terms of U.S. versus foreign securities, we're basically neutral on that. The U.S. economy is a little stronger than the foreign economies overall. Our companies and our earnings seem to be a little stronger, but our valuations are a little bit more expensive. Over in foreign markets, Europe, Japan, emerging markets, growth is not quite what it is in the U.S. presently, but valuations are much more reasonable to account for that. So overall, we're neutral. We like to own both in our portfolios. Now, on the bond side, I mentioned that the Fed is raising rates, and at the end of last year, we did see a fairly steep increase in interest rates. The 10-year Treasury is now around 2.5%. It actually bottomed in 2016 at around 1.35%. So that's a pretty steep move in a short period of time. And because of that, I can understand how It may make bond investors uneasy, but I'll remind you that not all bonds behave the same, and not all bond sectors behave the same in terms of their duration or interest rate sensitivity. So this slide, I think, does a pretty good job of isolating periods of time when the 10-year Treasury yield rose 100 basis points or more, so 1%. And it shows if you own long-term Treasuries during that period of time, your principal was hurt. If you own short Treasuries, not so much. You actually came out of the period of time generally positive. Other sectors that held up much better and positively in these same environments, this rising interest rate environment, includes short-term corporate bonds, high-yield bonds, and floating rate debt. And if you're a client of ours, you know that we approach fixed income from a multi-asset class and a multi-sector point of view. We don't like to concentrate just in one type of bond. We have a pretty well diversified fixed income portfolio that does include some treasuries, corporates, high yield bonds, and floating rate bonds. In terms of opportunities on the income side, I just highlighted how bank loans historically have held up and done fairly well in periods of rising interest rates, and we do own bank loan funds in many of our client accounts and our allocations, and we still think they're an attractive place to be within the bond sector. Bank loans are actually short-term corporate debt. Typically, the companies represented are rated below investment grade, so there is some credit risk there. One of the advantages is that the interest rate generally resets every 3 months, and if rate increases continue from here, courtesy of the Fed and the LIBOR rate, that could flow right through to bank-loaned investors, and we think it's an attractive place to be on the bond side or the income side right now. Another interesting area is municipal bonds. The initial reaction to the Trump administration was fairly negative for municipal bonds. So not only did interest rates rise, but some fears that tax rates would decrease in the economy, that had a negative influence on municipal bonds. Obviously, if you're paying less in taxes at some point in the future, the advantage of tax-free bonds goes down marginally. So muni bonds sold off a little bit last year. We see this not necessarily as a negative in the long term. We actually think this could create an interesting opportunity, as we do believe that the outlook for municipal bonds could very possibly change as we learn more about new policy and market developments in 2017 and beyond. So we think both bank loans and municipal bonds on the income side are interesting right now at these current levels. As you know, we are believers in active management. We do think it does make sense to apply some judgment and to be able to differentiate between different sectors, different stocks, different securities. One of the areas that we think there's an opportunity is this concept of time arbitrage. And what I mean by that is that I think an advantage that we have and that our clients have is that we can look and we can focus on the long term. Today, there is a significant focus on the short term, and it certainly seems that there's too much weight being given to the news of today at the exclusion of long-term factors. All right, and it's very common to extrapolate the recent past into the future, and this creates more frequent trading. And a lot of it has to do with the fact that there's very little patience among investors today for short-term underperformance. We think this creates opportunity, and the opportunity we're classifying as time arbitrage. What we mean is that we think that this behavioral edge can be created for those who focus on how an investment opportunity might perform down the road, few years out. if you can ignore some temporary bad news, you may be able to add attractive securities at attractive prices that should be priced, or our analysis shows should reward you down the road. And I'll say that, and I'll remind you that advice that sounds best in the short term is often bad advice in the long term. So remember that when you're open up your statements. Sometimes short-term volatility, while it's uncomfortable, it's a necessary part of investing, and it can actually lead to attractive opportunities, which, if you're patient and disciplined, we hope reward you in the long term. Another interesting opportunity we're finding today has to do with emerging markets, both on the debt side, bonds, and on the stock side. And this is a great chart from BlackRock that I'm sharing here, and it focuses on stock valuations. As you can see, emerging markets have lower valuations or P/E ratios than developed markets by a significant amount. On the bond side, emerging market debt offers significantly higher yield for similar credit quality than more developed markets. And if you look at the economies represented by emerging markets, they're growing at a much faster rate than the developed economies. So again, it does take long-term perspective, because emerging markets do have some risks that are unique to emerging markets, currency being one of them. But if you can extend your time frame out past 3 years, 5 years into that range, we think emerging markets are an attractive place to have at least a portion of your portfolio invested in. So just summing up, some final thoughts. Markets did treat investors pretty well overall in 2016. There was some volatility, but in the end, I think most investors were happy. If we look out into 2017, we see perhaps more uncertainty as new policy takes shape and we learn more about exactly what policy will be implemented. I'll remind you all that the key is to have a well-designed plan and to try as best you can not to be driven to make changes based on short-term predictions. We think if you can do that, if you can stick to a well-designed plan, and we certainly believe a good advisor can help in that process, we think that can only increase your chances of success down the road, and ultimately that's what we're trying to achieve. And finally, I'll remind you, bonds still play a very important role for investors. They help manage risk. Sure, there's some issues with rising interest rates on the bond side, but when times are tough, when equity markets sell off for whatever reason, whatever new risk is introduced into the marketplace, bonds are still an excellent diversifier and do a good job of preserving capital in those times of stress. So those are my comments. Dan, if you had any questions that people sent in to you, now would be a great time. I'd be happy to address them.
Sure. One of the questions we did have, Steve, and it's one that I've gotten over the last few days, now that the Dow has broken through 20,000 points, do we feel the market is overvalued, and is there anything different we should be doing?
Yeah, that's a great question. Very timely, certainly. Dow did just cross over 20,000 this week. But really, this chatter started weeks ago as we approached 20,000. There was a lot of discussion. I remember coming in each morning and hearing, is today the day the Dow's going to cross over 20,000? I'm not so sure how significant that number is. In fact, I don't believe it's very significant at all, so I would encourage you all to ignore it, quite honestly. I think ultimately a closing tick, a closing price, is not what we're trying to achieve. We're trying to achieve goals. We're trying to achieve objectives over the long term. And for that, as I hope came across in this presentation, we focus more on the fundamentals. How's the economy doing? How are corporate earnings doing? What are interest rates doing? These are all, I think, very important indicators that can contribute to you. The fact that the Dow is now over 20,000 to me is not necessarily significant. We do look at valuations. They're not as cheap as they once were, so that's certainly a concern. But as usual, there are different pockets of the investment universe that offer more value than others, and that's why we have the discretion and the ability to use our judgment to apply our capital and invest for our clients in areas that we think are more attractive. So, I mean, certainly it's good news. It's not a bad thing, but I don't think you can draw the conclusion that because the Dow is above 20,000, it's either time to raise cash and run to the sidelines or to get more aggressive. I think the takeaway for me is if you have a good plan, you probably don't need to do anything, and hopefully 20,000 is not the end game. It's more to be able to retire when you want, to be able to draw a certain amount of income if needed, and to meet those long-term goals. I think that's all we have time for today, so I thank you all for participating. Dan, as usual, thank you very much for your help. Our emails are both up on the screen right now. We're both available at any point in time to discuss your individual portfolio or any of the concepts or topics that we discussed here today. So thank you all. Have a good night, and we'll speak to you soon. Thank you.